Gentlemen. I am Mridul Mishra from the corporate communication team. And on behalf of K Ratings, welcome you to our today's Q2 and first half of FY21 earnings conference call. We wish to inform you that all participants are in listen-only mode, and there will be a Q&A session once the presentation concludes. During the Q&A session, you can please click on raise your hand option, which will enable me to unmute you for posing your queries. Also, please note that this conference is being recorded. Our management team is represented by Mr. Ajay Mahajan, Managing Director and CEO, along with other senior management personnel. Now I request Mr. Ajay to take over the proceedings, please.
Thank you, Mridul. Good evening, friends, and welcome to K Ratings investor call for second quarter FY21 and H1 of FY21. Due to certain commitments, we were not unable to hold this call yesterday and are holding this today. We are very keen to interact with you and share our performance highlights and also answer any queries that you may have. As you know well, our credit ratings business rests on two pillars: initial ratings based on new business generated, and surveillance, which is a kind of annuity business for us, for any rating agency for that matter. The first depends on how the economy behaves and what level of economic activity we are seeing. And the second one is more like an annuity business. Having said that, there is also a certain level of unpredictability to the surveillance business in downturns or whenever there are economic downturns, also because the same level of debt may or may not be necessary for some of those companies. So this, I think, a little bit of changes in the overall requirements of debt and the overall uncertainty in the economic activity, I think will continue for at least the next 2 quarters, and hopefully will get ironed out thereafter. An important point I must want to place with you is we also have a lot of our analyst work and a lot of our time somewhere stuck in a regulatory requirement to continue to give issuer not cooperating ratings, and a lot of our business gets doesn't get revenue for it, but gets stuck in terms of analyst time, rating heads time, group heads time, and so on and so forth. So it's an important point to mention nevertheless. How has the environment for new ratings been? Although the macroeconomic environment, as I just mentioned, has been tight this year, but is now beginning to witness improvement due to unlock measures, it is still in negative territory, as evidenced by the growth in credit to manufacturing and services sector, which are the key indicators of economic activity. Growth in credit to manufacturing has been 4.5% lower between the April and September period, while to services is minus 0.7% through the same period. Now, within manufacturing, the growth in credit to large industries has declined by 5.1%, while that to MSME has increased largely due to the guarantee support provided by the government. Further, the industry has surplus capacity with utilization rates still at about 47.3%. Not the latest numbers not known to us, but as of June, that was the number of 47.3%. Fresh investments in the sector are still quite low. And in a separate study, we feel that the investment in the economy that has been made so far is also hitting a very low point, as against a number of 27% plus last year. We're at 22% approximately this year. Corporate bond issuances have been higher, but shorter term issuances in the form of commercial paper have been lower. Most of the issuances in bond markets are from the financial sector or have been from the financial sector, and the only other exception, largely in terms of predominance, has been in PSUs. So PSUs have been a dominant player in this capital raise as well. Now, this has been the pattern all through the year, and we see additional liquidity facilities set up by RBI through LTROs, TLTROs, and so on and so forth, largely making capital accessible for high-rated entities and not necessarily across the board, which is a clear phenomenon that we've seen in the last 6 months, also due to risk aversion and risks to the NPAs in the banking system. CPI inflation reigning at 7.3% has not allowed RBI to cut any rates further, but keep the repo rate unchanged at around 4% levels, but still indicating a lot of accommodative stance and ensuring liquidity infusion across the board in the system. Now, let me come to our performance, which is critical. Let me first talk about our standalone performance. Our operating income increased by 7.5% from 66.43 crores to 71.40 crores in Q2. Expenditure was down 5.9% from 31.8 to 29.83 crores, hence an increase of 19.8% in operating margin, or operating profit, I'm sorry. This helps to improve our operating profit margin from 52 to 58%. PAT has gone up from 36.99 to 38 crores, and bulk of the PBT increase has actually been lost to larger tax incidents. That's besides the point. For the 6 months, including Q1 performance, total income was 122 crores as opposed to 128 crores approximately in the same period last year. PAT in absolute terms was 47.93 crores as against 50 crores in the corresponding period last year. So in many ways, Q2 has helped us, but Q1 plus Q2 still puts us slightly down over the last year by 5 or 6%. Operating profit margin is up from 40% to 43%, while net profit margin has been maintained at 39%. For the group on a consolidated basis, the results are a total income of 83.87 crores in the quarter versus 80.72 in the same period of FY20. PAT has moderated to 36.73 PAT moderated from 36.73 crores to 35.84 crores, a marginal decline there, again due to the tax factor. For the 6 months period, income was 130.77 crores versus 138.45 crores, and profit after tax 45.54 crores. The board of directors, based on this performance, have decided an interim dividend of rupees 8 per share, of rupees 10 face value share, basically. During the financial year, we have held several webinars on different industries. That's just to give you a progress of what we've been doing in terms of our outreach to clients. We've been reaching out to our clients in many ways. We've held several webinars in different industries for COVID impact and guiding our clients as to what we see across multiple sectors. There was concerted effort to build the brand with these sessions. The difference this time was the industry webinars had experts from concerned sectors also to share their views, as opposed to only us doing the talking. We were also knowledge partners of CII's Financial Market Summit in October, where the knowledge paper was released by the chairman, SEBI. Going forward, as mentioned earlier, we do expect sequential improvement in the economy, and our forecast for the full year is a minus 8.2% growth. There have been some affirmative steps that have been taken by the government. We have to give credit where it is due, and certainly so RBI in the areas of moratorium and one-time restructuring. We would be keenly watching all these developments to leverage opportunities that accrue from the same. We have not seen much momentum in bank lending yet. As I mentioned, bank credit for the first half is down 1%, and for the full year we expect a growth of about 3 to 4%. Except at the SME level, where thanks to the guarantee scheme we have seen pick up in credit books across the spectrum. We see strong risk aversion even today among banks. I've cited the reasons for that, and we still await a turnaround in risk appetite in the banking sector. With surplus capacity in the manufacturing and private sector still watching the government moves on capex, we may have to be patient before such investment in infrastructure sector comes in. Needless to say, we will seek to leverage opportunities that come our way, either the rating business or through our subsidiaries that have modestly tried to address the outside ratings business as yet. I would like to take some time to just, before I close my comments and move to question answers, I just want to comment on some of the things that we are trying to do. I have repeatedly said, and I continue to say this in a very affirmative manner, that CARE is on a firm path of transformation going forward. CARE has been facing challenging times in the past on both operating and regulatory fronts. In order to alleviate these issues, we've been making several changes in the organization. And I'd like to highlight 2 or 3 of those. First is looking inward. We are looking at transforming the corporate culture further. There has been a lot of transformation that has happened in the course of the last 2-3 years by a very conscious change adopted by management and also advised and ushered in by the board. But we want to carry that momentum forward. Our corporate culture is being changed to focus entirely on building analytical rigor, thoroughly complying with all the regulatory compliances, fearlessly expressing our opinions on ratings, and single-minded focus on rebuilding the company's reputation. I can't say this more authoritatively and more more seriously and more intently. So our quality of work will be our single biggest focus going forward. The quality of work we do collectively as a team, quality of work we do as business originators or business executors, and that will be our focus. We can lose business, but we will not lose our reputation. That will be our single biggest focus area. Admittedly, we have a lot of policies and processes that we have made changes to in the course of the last 2-3 years, and they're all good changes, and they're adopting them. But the best analysis emanates from passion for analysis. We are trying to inculcate that passion for analytical rigor across the rank and file of this organization. And having said this, creating this culture in an organization will take some time and effort, and it also requires all my colleagues at the top management, middle management levels to fully align with us to be able to implement this and effectively see and witness a change. Second important point is improving talent density. Now, in terms of the rating business, capable and knowledgeable employees create sustainable competitive edge. Ultimately, there is no denying the fact that we are in a knowledge industry. And in a knowledge industry, we carry so much data with us. We carry so much analysis, so much knowledge across the board. We are very large, or used to be exceedingly large in BFSI, but even today we are quite large in BFSI. We are large in infrastructure. We are large in manufacturing, and we are also adding newer products like structured finance capabilities and so on and so forth. But we want to continue to deliver high quality, knowledge driven analytics to our clients. And that is the focus of CARE. So we will want to continue to invest more in our talent as we go ahead. We will also not just looking at external talent here. We also have a lot of internal talent, and all those who are the right fit and can carry this renewed culture forward will be a part of this huge transformative journey. And the last point, an important point, is that we have to future-proof CARE. We have unfortunately been a single product company. That's the reality. Now, while our focus on ratings will remain core, nobody says that we are going to we walk away from that focus. We also have to do a lot of work in terms of looking at newer opportunities for CARE in some of its subsidiaries. For instance, we have a couple of subsidiaries that focus on risk solutions, and we also have a subsidiary that focuses on advisory businesses for SMEs, and we are trying to put a lot of strategy to work. We are not ready with it today. We'll spend the next 2 quarters maybe in fully understanding and analyzing and picking sectors or areas where we will want to organically and perhaps inorganically build certain businesses that are contiguous to the core capability of knowledge driven analytics of this company. So with that, I think I will close my opening remarks. I'm very happy to hand it back to Mridul, my colleague, who can then orchestrate the flow of questions. Thank you.
Thank you, sir. Dear participants, now we will begin a Q&A session. As said, please click on raise your hand option. I'll take you in the queue and unmute you for posing a query, please. Thank you. The first query is from the line of Mr. Mudit Minocha from Three Investments. Mr. Minocha, I'll just unmute you. You can please go ahead with the query. Yeah, Mr. Minocha, you can please unmute yourself. Okay, we'll take that later. Now, the second query is from the line of Mr. Vikram Damani. Yeah, Mr. Vikram, you can please go ahead. Hello.
Brother, are you in a position to unmute the people that raise questions?
Yeah, I'm doing that, sir.
Yeah, please do that. Thank you.
Okay, we'll take the query from the other person from the line of Mr. Manvardhan.
Uh, Good afternoon, sir.
Yeah,
Thank you for the opportunity.
yeah.
But I joined in a little late, so I missed out a part of your presentation. So just wanted to understand this quarter's result. Uh, was there some effect of some revenue moving in from last quarter to this quarter, or can we assume these numbers to be continued through the year going further?
Yeah, so it's a good question, Manvardhan. If I got your name right, um, I think there is some effect, there is some spillover effect, but I don't think the entire performance of this quarter can actually be explained by a few crores of revenue that may have transferred from Q1 to Q2. And while explaining Q1, we had mentioned that some of the surveillances we couldn't finish because of the lack of audited financials being available. To be honest, we haven't done any internal analysis on this, and we were to normalize for Q1 and Q2 transfer of business in any way. You could look at the H1 numbers. Let me draw your attention to H1 objective clearly while stating Q1 numbers was that we will want to be as close to last year as possible. Having said this, when the GDP degrows -8, -9%, we have to obviously allow for certain adjustments on the downward side to that ambition that we stated at the start of the quarter. We want to restate that ambition that we want to be as close to last year's performance as possible by the end of the year.
Right. Thank you. Thank you. That clarifies my.
Thank you, Manwar.
The next query will take from the line of Mr. Samar Singh, TPF Capital. Samar, can you please go ahead?
Hi, am I audible?
Yes, Samar, please go ahead.
Yeah, thanks, brother. Hi, Ajay. Good to finally see some positivity coming in our numbers after a long, long time. So congratulations on that. Two questions. First one is, you've sort of given your long-term vision on what you want to do, which is the analytical vigor, improve that, and hopefully over a period of time, the investment community appreciates that, and therefore we get more business from various companies. That's the long-term goal. What do you see as what are you going to be pushing for over the next 6 months, as far as the company is concerned, in terms of getting sales grow atop?
Sure. Honestly, Samarth, I wouldn't give you a convoluted answer. The simple answer is that we will within the scope of entire economic activity across multiple sectors and the relationships we carry and the potential relationships that we constantly review with our management team that's on the call as well. It's an ongoing exercise to improve outreach to clients. It's an ongoing exercise to improve connect and continue to originate fresh business. But we need a little bit of luck as well. I have to be honest with you. This is not just about CARE. This is about the rating industry in general. We rate debt instruments, and if there is no project capital expenditure in the economy at a point like this, and as you know, the intervention on the investment side by corporate industrialists at this moment of time is very low. People are biding this time. They are focusing on cost savings. They are focusing on somehow standing through this crisis, and not necessarily taking what should I say, courageous risks, so to say, in order to make investments. So automatically then, despite our efforts, we will not necessarily see as much as much return coming our way as we could in buoyant times. Having stated that disclaimer, it is fair to state that we are working hard to improve our outreach. We are reaching out to financial institutions. We are reaching out to financial sponsors like funds who play a big role in terms of at least understanding and ascertaining which rating agency brings what quality of talent, knowledge, and skill to the table. So all our top management team joins me in saying this to you. I assure you that we will leave no stone unturned in the short term as well to be able to improve our numbers.
Okay, thanks for that. And my second and last question, the one thing you can control is sort of your capital allocation policy. And I know that various investors have reached out to management multiple times talking about a preference for a buyback versus a dividend. How do we continue to go the dividend route? Could you just help us understand why is it that we are preferring one way of returning capital versus the other?
Honest answer, Samarth, on this is that dividend it comes out of our ongoing operations, and those decisions are somewhat more routine as compared to a buyback that requires a very comprehensive conversation with the board. I have just been here 2 quarters. It takes a little more time to first put our strategy on the table to be able to say whether the cash we have on balance sheet is likely to fall short or likely to fall surplus over the plans that we have in terms of building out other businesses. Like I transparently said, that those plans are firmly etched in our minds, that we must build a couple of businesses that provide a longer term fillip to our revenues in a sustainable format, and businesses that are aligned to our core competency is what we are talking about. But until a comprehensive exercise is done, we need time to be able to address the issue that you raised. The rest of the dividend policy comes directly from our operating sort of performances, and therefore doesn't require the kind of work that a buyback requires.
I completely understand that, Ajay. I understand that a part of the cash on the balance sheet is going to be used for inorganic opportunities. I was in fact just talking about the cash flow being generated from the operations. I think that should be used. I think that should be returned in the form of a buyback as opposed to a dividend.
I have to confess that this I have not necessarily spent time in understanding this, Amar. I can tell you that the next time we meet, we would have thought through this very well.
Thank you so much. Thanks.
Thank you.
Yeah, the next query is from the line of Mr. Deepak Poddar. Mr. Deepak, I have unmuted you. Can you please unmute and pose your query, please?
Yeah, hi. Thank you very much, sir, for the opportunity. So, just wanted to understand. Now, you did mention that FY21 we will try to be as close to last year performance. But basically, as we see last year, our EBITDA was close to about 80 crores, and this quarter itself we have done about 40 crores. So are we being a little conservative when we say that? So and sustainability of the current performance. So any comments on that? Yeah.
The fact is that when I talk about numbers, I actually had, when I say last year, I actually have more a top line focus while making that comment as opposed to a bottom line focus. So that is a disclaimer that I should put when I said that. The second point is that, frankly, the jury is still out on how Q3 and Q4 will work out. Q2 clearly has been a very good quarter for us, but the surveillances as they fall through during the quarter, plus the initial ratings combine our revenue pool for that quarter, and it's having seen a good Q2, and we have to necessarily look at when the next surveillance is falling due, and when we look at the stock of our next few quarters, it may not be possible to repeat a Q2 performance in every quarter, is what I would say. Also because of our accounting policy, because the accounting policy takes in revenues coming from surveillance into that quarter, bulk of it, and doesn't necessarily provide for smoothing out the earnings over the next 12 months, as some of the other sort of agencies probably follow. So the point I'm making is, therefore, by definition, our earnings and our revenues in every quarter will belong to, or will emanate from, the stock of business we actually put through in that quarter. It has nothing to do, or it has very little to do with the kind of work we have done in the previous quarters in any quarter. Bulk of our earnings come from the work we do within that quarter, and that work automatically gets classified into different quarters basis when the 1 year surveillance is due, and the basis of how much flow of initial ratings is flowing in that quarter. So I hope I have explained the logic to you. After that, obviously Q3 will possibly correspond more with the Q3 of the previous year than correspond to Q2 or Q1 of any year. And therefore the trends in our business can actually, unless we change accounting policy, for which we are not ready today, unless we change that, the trends in our business have to be honestly compared on a corresponding quarter basis far more than sequential quarters. I hope I've answered.
Yeah. I think that's it from my side. Thank you very much.
Thank you. Thank you, Deepak.
The next query is from the line of Mr. Rohan Sharma from Multi-Act. Yes, Mr. Rohan.
Hi. Yes, thanks for the opportunity. So my question is with respect to the strategy. So what you are suggesting is you would be making investments in newer opportunities outside the rating business. So what kind of cost, or what kind of employee strength are we looking at for these newer businesses? So currently we are doing a run rate of around 28 crores on the employee cost. Where do you see this number going forward? Maybe let's say a year from now, or year from now, or 2 years from now. Thanks.
Rohan, Rohan, complete your question.
No, that's it.
Okay, Rohan, my honest answer to this, like I've been saying, and I've been pretty consistent on this right from the first time I did the call. Actually, this is the second call. We couldn't do one in the last quarter. My message here is that we are not ready with the numbers today to be able to tell you how employee cost will move going forward. But I can assure you one thing: we will not want to do a business that's so gestationary that I take the cost today and the returns come 3 years later. So we want to be very focused on making investments that are relatively more productive and are EPS accretive. It can't be in the same quarter, but should be accretive. And as we analyze the opportunities, whether organic or inorganic, that will be one of the key metrics that we'll keep in mind. I hope that high level philosophy helps you at least understand the management philosophy and the board philosophy, if I may say, with which we want to approach this. We are not approaching this from a perspective of make large investment today and forget about when the returns come. It could take 3 years, 5 years for returns to come. That could be done in pockets for small investments. For a large part of the investment that we would want to ever make, it will be done on the metrics of payback period and obviously ROI, and also the time that it takes to start generating positive cash flows from that investment.
Sure. And on the ratings business, what about the ratings business from an employee cost perspective? Would we be looking to increase the strength of the employees, or considering that the scale of the business has reduced a bit over the last 2 years, would we be reducing the employee strength? And so what about the cost structure on the rating side of the business?
So here I would just say that CARE has always been exceedingly cautious on its cost, and this goes back to even times when I wasn't here. For all the last few years, I've seen it's been a very cost-conscious culture in the company, which is very good. So I don't really have to change too many things there. We are very careful with every rupee that we spend as a company, and I'm very happy to share that philosophy At least that prevails at CARE. Now, to answer your question squarely, as opportunities emanate, we may have to bring in some talent from outside. And like I said at the outset, there is reasonably good talent internally, and that talent and the external talent will come together and create the right type of mix of manpower quality that we will have for our future growth. That's a high level philosophical statement. Now, actually, it's not just philosophical. I've also shared with you that there will be some influx of external talent wherever we require that talent. For instance, in subsidiaries, we already have some talent, but in some subsidiaries like advisory businesses, we need some higher quality talent from the street, because our focus today is on SME business, for which we have very good talent. But on the large corporate fund management or any other ambition that we may carry, we will want to bring in influx of good talent. But I can only leave this thought with you that we will be very cost conscious, and but not at the cost of dropping quality. Our focus is quality. Quality in everything we do, whether it is SME advisory, whether it is large corporates, whether it's global funds, if we want to open up some opportunity there in advising, or it is any other business, we'll focus on quality, and we'll also focus on payback and return on investment. So we will be as judicious with the company resources as we are with our own resources. That's an assurance to you. Lastly,
Sure.
lastly, I want to make one point, that technology will help us in managing cost. In the past, what used to happen was that if we got 100 more credits, we would want to hire 100 more or 10 more or 5 more analysts. Now here, while that equation may not immediately be helped, but over a period of time, as we focus more on internal workflow technologies, as also artificial intelligence and machine learning technologies, which we are very seriously working on, I'm very happy to announce we have hired a very senior person in our technology division. He's joined as the Chief Information and Technology Officer recently, apart from the other senior gentleman, Umesh Ikhe, who runs our CRSPL business. So we are bringing in very selectively quality talent that will help us completely make the, leapfrog us from being an average technology company to a cutting edge technology company. When that happens in full force, it might take 2 years to happen, or maybe 3 years to happen. But when it starts to happen from today, even on a piecemeal basis, it will impact our productivity quite substantially. And so I expect actually to make do, unless absolutely necessary, to make do with the same people that we have, use the senior talent to improve their sort of bandwidth more, give them more opportunity of growth internally in the company, rather than keep hiring more and more people, which then increases the fixed cost and the operating leverage of the company, and then creates a problem should we go through a downturn like we did in the last 2 or 3 years. So I hope I have comprehensively answered your question.
Yes, yes. Only one last thing. So on the industry benchmarking, that the exercise that we had started, so where are we on that? Is that exercise complete, or still there is some possible increase in employee cost on that front?
Okay, it's a good question. There are some parts of the company which we obviously going through microscopically, that may need some more revisions. I can tell you this, Rohan, that it is not possible to completely benchmark yourself to market on a single day. I have worked for companies that have had far higher level of resources, and even those companies struggle to be able to correct accumulations of such sort of dislocations over 4 or 5 years or even longer periods in one particular year. But the message is very simple. If we pay peanuts, we get monkeys. So we will not pay peanuts. We will make sure the quality of our people goes up, but we might save on the aggregate. The numbers may not bloat, because we will be very conscious of the quality of talent we hire, and that if the quality of talent we hire can actually do as much work as 2 or 3 average people or below average people do, then necessarily costs don't bloat. So my simple point is, productivity and quality are the 2 mantras for
that has come for a quarter, how much is attributed to new business? I mean, just want to get a sense of what is the new business momentum like versus historically.
See, the new business, the way we track is actually quite a mishmash, because there is initial revenue coming from new business, then there are surveillance revenues that come from annuity business, but within surveillance we get a lot of enhancements from time to time, and some drops as well, as debt extinguishes with time. For instance, a 5-year equal amortizing bond will have an average life of 2.5 years, while I'll have to do surveillances for 5 years. So, it becomes very challenging to actually separate the two. Last time I had conjectured a headline split of somewhere between 25-30% in a very good year to 20% in a weak year. But I think I would probably stay with some a very broad guidance of that nature. It's very hard because we actually don't do this level of split because of the complications I just mentioned.
Sure. So no, that's something I appreciate. However, from your point of view, if you had to, you would be, uh, essentially looking at the performance of the team, right? And you would want to look at what was the effort to outcome, right? So I mean, internally, at least there must be something that you would want to look at in terms, because a lot of effort would go into new and relatively less effort would go into surveillance from a sales point of view, right? So what do
Yes.
you look at then?
Oh, clearly, like I said to you, we have our own detailed MISs. I didn't say that, but I'm corroborating what you said. Literally, our executive director Mehul Pandya and his team and I engage very often, and we look at the numbers. The MIS flows quite smoothly literally on a daily basis. So we are able to actually track what's going on. So rest assured that internally we are totally focused on the key metrics of our businesses, and we stand committed to continue to improve them.
Sure. And as an extension of that, right? I mean, just to is it fair to assume that last say Q3 and Q4 of FY20, it was they were bad years, bad that was a bad sort of period, right? So again, 20 would be new and 80 would be old, assuming that there is a slight sort of run over of debt. You would get say 60-70% of the revenue you should be getting from those 2 quarters at least. Is that a fair assumption to make?
It's hard without, see, like I said to you, in general, I would go with your assumption. The trouble in our case is that I'll have to look at the quarterly stock of the business that falls into surveillance basket for that quarter, to be able to then suggest a weighted average life of remaining debt in those corresponding quarters to be able to make that assessment properly for you. So unfortunately,
Correct.
that level of analysis I don't have today, or frankly, we do this one time at the start of the year to just get a broad sense. After that, it's very hard to track it on a individual case by case basis. And I think if we do this on an average portfolio basis, it is helpful enough. So we really don't extend it to an individual account basis to that extent. I'm sure the business development team in its own analysis will be doing this. But so it's hard for me in this call confirm to you whether that number is 70 or 80 or 60. But let me tell you this, that we are obviously in the marketplace going to be extraordinarily competitive in terms of not letting go of any business because we are a company that will act with renewed vigor. We are focused on analytical rigor, I mentioned, on quality, and our business development team is also fairly smart to be able to grab opportunities in the marketplace. So we will, I can give you a high level philosophical comment that we will not let go of opportunities.
Yeah, sure. No, that's very helpful. How is pricing evolving given that the market breadth is worsened in terms of, oh, I mean, actually would love to understand, do you see market breadth or number of participants raising capital having worsening over the last few months? And as a result, if that is true, has the pricing worsened because of that?
It's in general, I think on pricing, I would just say this to you, that in India, and I'm saying this partly in a very light-hearted manner. In India, fee-based businesses have always competed to get fair pricing.
Yeah.
It is very hard to get fair pricing in India in general, and that's my high-level comment. I'll not go more into this, but I can tell you this: that pricing comes when people see quality. Pricing comes when people see effort, when people see seminars, when people see knowledge, when people see engagement. When somebody picks up the phone, calls our analyst, sees a quality input, pricing will come. If pricing has even shown some pandemic-related slight moderating trend, I'm quite confident that pricing will come, and as long as we deliver good quality, and my team is committed to that. I'm committed to that. So that's my comment on pricing. Now, the other point you mentioned is about concentration of debt and whether is this broad-based or not. In my opening remarks, I said this: there is concentrated corporate capital raising activity at the creme de la creme of the Indian corporate base. The large keep getting access, the small and medium don't get access, very simplistically because they don't necessarily have the ratings and the balance sheet wherewithal to be able to be seen in risk-averse markets, to be able to be seen to be good enough for investors' capital. So that's the reality. We have seen more concentrated play of LTRO, TLTROs. We have seen concentrated activity at the absolute top, but the medium-sized companies have actually deleveraged through this process and will continue to deleverage before economic activity picks up in strong momentum. We have also seen bank loan ratings fairly steady. We have seen capital market activity reduce in the short term as well. Commercial paper volumes have dropped through this period, whereas long-term bonds have improved for the reasons I just mentioned, where some of them are from the oil refining space. A lot of capital raising is happening in the banking, financial services space, housing finance companies. So more secure businesses that have seen strong collection efficiencies and all of that. But other than that, we haven't seen a broad-based, leveraging increase in the system, and therefore hard to say when we see that back. But through these quarters, we have to chip away and keep grabbing opportunities that come our way sporadically through active business development engagement with clients. No specific opportunities, I can tell you, coming from capital expansion or projects purposes.
Sure. That is very helpful, and good luck for the coming years. Thank you.
Thank you, Akshay. The next query is from the line of Mr. Ritika Dua from Elara Capital. Yeah, Ritika, you can unmute and please go ahead with the query.
Yeah, am I audible?
Yeah, hi,
Yes,
Ritika.
Ritika, please go ahead. Yeah. Ritika, you have muted yourself. Yeah, can you please unmute and pose your query?
Am I audible now?
Yes, please.
Okay, my
Yes.
apologies. So thank you for the opportunity. Sir, because rating business, it's difficult to see on a quarter-on-quarter basis, and I understand that. But can you confirm a trend which we are, seeing, though we don't have access to a lot of databases, but then whatever limited we have, we think that to some extent your market share has improved in first half. Could you confirm that trend, sir? And if it is, and in which segments have you seen largely improvement in the market share? Maybe if you could break that up in the bond segment, maybe by rating categories or whichever way is possible.
Ritika, I'm unfortunately not prepared for this question because market share analysis requires obviously numbers from other rating agencies. A lot of other peers do not have this information in the public space. I mean, you as a senior analyst in the business will have more access to their numbers than I have, to be honest. But I can tell you that at this moment of time, I can't answer this question of yours. But I can say to you that, like I said, the performance that we have shown in Q2 is coming from both a combination of the initial ratings business and surveillance. We are definitely working very hard to build our share in the capital markets business. We believe that that's a segment that we cannot ignore. In fact, that segment should take as much attention of ours as bank loan segment does. We don't differentiate between the two, but their regulatory landscapes for both the businesses are somewhat different. Going forward, our emphasis will be to continue to work hard on both the segments, regardless of whatever sort of market share we have in the bank loans. We will want to continue to focus a lot on capital markets, not just on vanilla issuances. We also want to focus on more structured business going forward. We want to be at least a serious contender to activities in capital markets like REITs, InvITs, and so on and so forth. We are creating some dedicated internal effort in that direction, and we believe that these are the long-term product capabilities that rating agencies like ours must build to stay absolutely competitive in the marketplace, and be really be an authority on some of these subjects going forward. So high-level answer. Percentage-wise, I'll have to revert to you after some more internal analysis.
No problem, sir. So I wish you the best for the journey. Just one more question. So in your press release, you've mentioned that there would be some ESOP expenditure which would occur from the third quarter onwards. Could you guide a bit on that?
Yes. So as you are possibly aware, there have been an approval obtained from investors in the AGM, ratified by the AGM, for 10 lakh stock options towards employees. Some of them are to me, some of them are to the employees, and these stock options will be granted or have been granted, let's say partly granted, partly will be granted in the second half of this year. Because they will be granted in the second half of this year, there was no way for us to account for the ESOP related expenditure for the full year or reflect that in the first half in any way. So the comment is limited to this, that the second half will see an element of ESOP expenditure which is missing in H1 completely, and therefore in a way slightly betters the expenditure position for first half versus the second half.
Sure, sir. That's helpful, sir. Also, all the best. Thank you.
Thank you very much.
The next query is from the line of Mr. Nitesh Jain from Aditya Birla Cap.
Hi, Nitesh.
Yeah, hi, can you hear me?
Yes,
Yes.
Mr. Nitesh.
Hi, Ajay, how are you? I mean, good to hear from you once again.
Very well, Nitesh. Happy to take a question from you.
Yes. So I have, couple of small questions. Number one is on, the business franchise of Care Ratings. So in the last 2 years of turbulent period, be it right from IL&FS crisis and then the company had an interim CEO, and then for some times, directionless type of situation. Has the customer base of, the fee-paying customer base of Care Rating got eroded during this period, or was it intact? It's a very simple thing to, for example, if you had 100 X number of fee-paying customers, say 3 years when everything was fine, are they today same 100, or are they 90, or are they 105 or 10? How is it?
All right. So Ritesh, it's a very good question, and I asked for this information from my colleagues, and they very happily provided to me, but not exactly in the way that you have asked this question. So I will answer this in my way right now, and perhaps come back to you comprehensively later if I'm in a position to actually share a lot of detail. But let me answer it in my way. I think in the last two or 3 years, a lot of damage was essentially done in the NBFC space, right? And in the NBFC stroke, BFSI, let's call it in general, whether it's an IL&FS that we talk about, or we talk about DHFL, a large part of our problems emanated in roughly that space. and therefore there was an immediate loss registered of income in the pursuant couple of years on surveillance incomes arising from the loss of those clients, because those clients didn't need any more money to raise. They were not operating businesses anymore in many ways. So, or at least parts of those companies were not operating businesses. So the point is that there is obviously a certain level of permanent damage to income that some of that sector players cause to us. That is something I can share with you. But other than that, I think the business development and the rating teams internally have done a fantastic job of holding the franchise together. I mean, I'm not now getting into an Excel spreadsheet where we say 100 versus 95 or 100 versus 105, but effectively, barring the damage limited to a few high-profile issues that we may have faced through that period, by and large, our teams have done a fabulous job of holding on to the franchise, and that gives us a rock-solid opportunity to build upon that further, rather than to first sort of fill the pit with what we lost, so to say. So honest answer is that we didn't have much damage to the franchise, thanks to our clients who stood by us, and thanks to our own teams who worked very hard to stay engaged.
Okay. And so basically my question was pertaining
that in certain areas where pricing is too low, right, and we believe that we don't get compensated in those areas, it could be the lower end of the SME segment. If we consciously decide to understate that segment because the segment doesn't pay for my cost, then that's a very conscious, happy exit situation from our perspective.
All right, wonderful. Thank you very much, and all the best. Yeah.
Thank you. Ritu? Hello? Ritu? Ritu, you can hear me?
Yeah, Mr. Parthiv, hello.
For some reason, I think
Mr. Parthiv, please go ahead.
Yeah, hi, sir.
Yes, please.
Hello. Yeah. So, almost all my questions have been answered. I just had a small question. Just wanted to know by when can we touch our 2018 top line and profitability with all the initiatives taken by the company?
Sir, if life was so predictable, then life would be so easy then. I mean, it was so predictable. That's all I would say. Obviously, suffices to say that our intent is to catch up to those numbers fast enough. We also have to understand and appreciate that 5 years ago, there were probably 2 less rating agencies in this business. So the rating revenues have obviously got split. Whatever we do, the size of the pie is not growing as much as the competition in the sector has grown. Having said all of that, we will want to work very hard, like I mentioned. We will want to work very hard on our quality, on our outreach, on our new product capability, on our rating revenue businesses mainly, but also on our non-rating revenues to augment and de-risk the ratings business in difficult years. That's the objective. So we are working on each of these in a very methodical, focused manner, and under the broad guidance of the board as well. So my honest answer to you is hard to predict when I'll get back to 2018 numbers. There was a big hole that got created because of the NBFC issues that we just talked about, and those are fee-paying clients, large fee-paying clients. The NBFCs in those times were leveraging much more than they leverage today. The ALM regulations and compliance conditions in 18 were very different from what they are today. So very hard to hazard a guess on that. All I can say to you is that we will definitely target to get back to the maximum revenue that CARE has posted in the past as the first milestone that we should focus on internally.
Okay, thank you so much, sir, and best of luck for the upcoming quarters.
Thank you very much. Thank you.
Thank you. Now, we are short of time running, though I'll take the last question for the day. This would be from the line of Mr. Ayaz Motiwala from Nivalis.
Hi, Ayaz.
Yes, can you please unmute and pose your query? Yeah, Mr. Ayaz, can you? Yeah.
Yes. Now it's got unmuted. I'm so sorry. Yeah, hi Ajay. Thank you for taking my question and this opportunity before the close of the call. So one question sort of related to the post ILFS NBFC situation that you talked about in fairly good detail was the changing landscape in the financial sector business and your sort of presence in those clients. So you've talked about the big getting bigger and taking more share. In terms of CARE's positioning, it looked like it was focused on the emerging corporates and the mid market. So do you face that challenge as you go back to in your reach out program to grow your business? So that was a question on your own business, and if you could throw some light in the context of the development of the debt market, which is going on, and this listing of papers across stock exchanges. Do you see that as a welcome positive development, something what we've been waiting as observers and investors for the last 10, 15, 20 years?
Yeah, so there are two parts to your question. The first one I would say is that, while the focus of our company through the bank loan ratings business specifically may have been more emerging markets and what we call not emerging market, but emerging corporate led sort of a strategy. And I'm talking about the past when I wasn't here, so I may be wrong. But we have also had very large accounts in this company. So it's not that the biggest oil and refinery major we do a lot of business with. The biggest corporate house in financial services we do a lot of business with. So it's not a fair. I'm not saying that you're being unfair, but I'm saying that statement is not necessarily factually correct. That we are not in large corporate. But yes, there is always room for growth. So when you ask me this question, it only encourages me and motivates me to do more in that segment, if that's the perception. That's one. I hope I answered the question.
Sure.
And the second part,
yes.
The second part of your question is more, in a lighter vein, I'd say that, I joined banking industry in 1990 and I left in Jan 2020. All 30 years we've been talking about corporate bond development in this country. So that's a factual position. Maybe a few years left over when I joined and a few years right. We'll keep talking about that. But in all fairness, this capital markets businesses are not easy for people to fathom. Only private capital and collective capital through solid investment management skills like mutual funds understand the mark-to-market implications, the lack of liquidity implications through difficult times. And others would, even if they're allowed to participate, will create some liquidity to start with, but will press the panic button the moment the MTM starts hitting them. So it's not a business for everybody. It is a business where you really need to understand credit very deeply. And I think whenever we have in this country tried to extend using bank loan ratings or bank loan business as an extension to capital markets, we have failed miserably simply because we have not necessarily had the right pockets of investors focused on those segments. There has to be a high risk capital game. If A-rated papers in India would trade at 8%, then where is the cushion for market, and where is the cushion for any absorbing any fluctuations? And banks also started to be big players in that business, but eventually realized that the capital at risk is far more through MTM fluctuations to be absorbed through P&L as compared to accrual loans, which could even accrue at 7%, but can hide behind CASA and other deposit cost of funds, essentially obfuscates a lot rather than reveals a lot. In my own way, I would say that. So the long and short of my answer is that capital markets and the depth of corporate bonds is a very wide subject. It requires a supra-regulatory approach to understand how multiple asset investor classes can be built into the domain of capital market products, who understand mark-to-market implications, who understand liquidity implications, who understand ALM implications of the underlying issuers, and obviously understand credit very deeply. It will take a little time. Until that is done, until the frameworks are built the appropriate way, I would think we will still play on the fringe. And when interest rates are very bullish, economy is doing well, you will see extensions of some BBB pluses also raising some money at 11-12%. But the day one guy chickens out at 18%, the next price will be 30% bond yield. So that doesn't work in anyone's favor. I've given you a philosophical answer. We can debate this separately another time if you like. But this requires a lot of work, concerted work from multiple investors and from multiple regulators coming under one umbrella with one single-minded focus as to how to build capital markets, and which is so important also to de-risk the banking books. Actually, I remember a few years ago, there was a circular from Reserve Bank of India saying that more and more incremental debt on those companies that already have access to 25,000 crores or more of collective debt from the banking system has to come from capital markets. I don't know what happened to that circular thereafter. I lost touch with it a little bit, because if that were to be implemented, then the fact is that company, regardless of its rating, has to raise per force incremental liabilities only through the capital markets route. Now, has that happened, not happened? What happened to it? COVID has obviously upset the apple cart, but hopefully when things come back and normalcy is restored, this is a very important subject that requires discussion, because ultimately resources in this country will always be somewhat limited, being an emerging market, government running large fiscal deficits, and therefore access to capital markets, which also allows foreign institutional investors to come in a very big way, is the only answer to the collective capital requirement of the corporate and institutional sectors in India.
Sure, that's very, very helpful, Ajay, and I would take the chance to have this offline chat as you suggest. And I will just leave the remark on this, in the context of our call and the time and the last question. I have one bookkeeping question, but just that we have had these fits and starts to it. The recent Templeton episode may be the detractor, but the REIT and the in-REIT norms focused on infrastructure may be the positive for capital market led fundraising instruments that you talked about. So we remain hopeful, and hope that CARE has got its got its self completely sorted out with talent and people, that when this wave were to come in, and that may last for 10-15 years, that CARE is right at the crest of that. So the question that I have on bookkeeping was on the ESOP, which you partly touched upon, and the accounting related to that. So earlier you were the company was taking some 10-12 crores of ESOP charge, and you said that partly has been accounted for, but we don't know the pricing, etc., for this round. So if you can throw a composite light on that aspect of costs on ESOP and accounting, that will be very helpful before we close the call, please.
Make do with, I'm not the CFO, so make do with my limited understanding on the subject for now, please. And we can come back. My understanding is that as the ESOPs are granted, there is a value, obviously, to the inbuilt option that is given to the employee, and that option needs to be priced, and a cost of that option needs to be taken into the books, right?
That's correct,
Now,
sir.
so the value, the strike price of the option is important. The time to vesting is important, and that goes into the formula of calculating on the amount of cost that the financials of the company has to bear. The simple point I was making was that since the grant will come in the second half of the year, not as of 30th September was the grant done, there will be obviously a higher cost to ESOPs as compared to zero cost to ESOPs that reflected in the first half.
So no issuance has taken place till 30th September, meaning no strike price has been decided.
Yes, no issuance had taken place till 30th September. That's correct.
Okay.
Yes.
Yeah. So from what we see the numbers, there is currently no charge on account of ESOP on a prorated basis, because there isn't clearly a strike price number and a time to it, as you said.
Absolutely.
Okay.
Absolutely.
Great. I will not take over liberties on that. Really appreciate your time, Ajay, and wishing your team a happy Diwali and all the very best for as you use the word rebuild this company and take it to higher levels than its past glory as well. Thank you very much.
Thank you very much, Ayaz. I really appreciate your comment, and that also I will take the opportunity as well. Thank you, Ayaz, to wish you and all other listeners and all investors, everybody who's on the call here, a very happy Diwali, season's greetings, and we'll continue to meet as often as we can. Thank you very much.
Thank you, sir.
Thank you.
That was the last question taken up for the day. Ajay sir, would like to give some closing remarks?
Well, Mridul, nothing really. I think we have. I've gone through my initial remarks. I've gone through the Q&A. I will only say to everybody that we are a very concerted team at the top, totally focused on performance and quality. We are not promoters of the company. We are management. We have been brought in to make certain changes to transform this company to a higher level of performance, both operating performance, higher level of market benchmarking, higher level of quality in what we do. And I want to assure all the investors that we remain steadfastly focused on these objectives. Thank you.
Thank you, sir. Thank you, sir. With this, I'm closing the call. Thanks all, and happy Diwali.
Thanks all. Happy Diwali.